I'm Dawson Schmidt here with the latest stories and developments in this week's Commodity Roundup on Trader PhD.
With 3 months left in the marketing year, U.S. wheat exports are performing well compared to a year ago. High supplies and demand from key trade partners have benefited shipping this season. The latest USDA data showed wheat export inspections totaled 485,000 metric tons last week, down slightly from the previous week, but up from a year ago. Total wheat movements for the 2024 and 25 marketing year reached nearly 17 million metric tons, up 18% from the previous season. Mexico has continually led commitments of U.S. wheat purchases, which are up about 28% for that country. Shipments to China are down more than 90%, but that has been mostly offset by increased demand from South Korea and Japan. Strong competition from other global suppliers such as Australia, Russia, and Canada limited the rebound in U.S. wheat exports. A strong U.S. dollar has also played a role. While outpacing last year, total U.S. exports remain 3 to 4% behind the 5-year average. Higher hog prices this year are helping producer margins as supply and demand become more balanced following years of supply gluts. However, producers could still be hesitant to expand herds, according to Smithfield CEO Shane Smith. Company executives noted during an earnings call this week that expansion is typical when profits return to the industry, but that may not be the case this year. Breeding herd contraction was prominent in 2023 and 2024, with sow slaughter sitting at elevated levels. Weekly trends now show that sow slaughter is slowing down this year and is down 5% year to date. Meanwhile, overall pig processing is down 1%. Smithfield has been cutting pork production to align with demand. Demand for U.S. pork has been relatively stable, but wholesale prices are holding above year-ago levels. The industry continues to moderate the impacts of current trade tensions. Smithfield says it expects sales to grow in 2025 as the trade situation remains fluid. Tighter supplies have been keeping fertilizer prices elevated, but the U.S. working with Russia could help alleviate global availability challenges. U.S. and Russian officials started talks yesterday on a potential ceasefire in the war between Russia and Ukraine, and on the table is the safer passage of nitrogen exports from low-cost supplier Russia. A statement from the White House said that the U.S. will help restore Russia's access to the world market for agricultural and fertilizer exports. Josh Linville, Vice President of Fertilizer at StoneX, says the global nitrogen market remains tight with current supply issues.
Look at the nitrogen. The urea side is still extremely tight from a supply situation. European natural gas still remains high. They still remain at 75% operating rates, which removes about 3.5 million tons of urea production, about 2 million tons of UAN production. Chinese export flows of urea still remain almost next to nothing. The government's been very successful with this export restriction program they put in place. Their prices are low, their inventories are high. That checks both of the boxes they wanted to do. What does that mean for the rest of the world? 2025 or 2024, the numbers we looked at, they're about 5 million tons short of what they would normally export in a 12-month period.
Bloomberg intelligence analysts say easing tensions in the Black Sea will support those lower prices. Thanks for watching. I'm Dawson Schmidt, and this has been Trader PhD.